After every Bitcoin halving, the same concern returns. Mining revenue has been cut. Older machines may shut down. Public mining companies may struggle, and people ask whether enough miners will remain to secure the network. The pressure is real. The block subsidy is 3.125 Bitcoin. Transaction fees can be small, while competition for the same rewards can intensify. During periods of compressed mining revenue, an older ASIC may fail to cover even its electricity bill, while a newer machine beside it remains above its power-only break-even point. Yet miners are still operating. Large facilities are still consuming power. Newer machines are still being deployed. So if the economics look broken, why are miners still here? The answer begins with a better question. Unprofitable for which miner?
To understand the economics, we first need to understand the job. Mining software, often operated by a mining pool, selects broadcast transactions and constructs a candidate block. Its header links to the previous block and commits to the new transactions through a Merkle route. An ASIC receives versions of this 80-byte header and runs them through Bitcoin's double SHA-256 hashing process at extraordinary speed. Mining is often described as solving a complicated mathematics problem. That description is misleading. The machine is not working through an equation. It repeatedly generates hashes, looking for an output at or below the network target. Almost every result fails. Think of each hash as a lottery ticket. More hash rate gives a miner more attempts per second. It increases the probability of finding a valid block. It never guarantees one. When the nonce range is exhausted, mining software changes other data to create another header to search. When a valid result is found, the block is broadcast. Full nodes independently verify its proof of work, transactions, and consensus compliance. If the block is invalid, nodes reject it, regardless of how much computing power produced it. If it is valid and enters the accepted chain, the miner earns the 3.125 Bitcoin subsidy plus the block's transaction fees. This is the role of proof of work. It makes attempts to rewrite Bitcoin's transaction history computationally expensive, while full nodes remain responsible for enforcing the rules.
An ASIC is a specialized conversion machine. Electricity goes in, hash calculations and heat come out. 3 numbers describe its performance: hash rate, power draw, and joules per terahash, J per T, which measures how efficiently it converts energy into hashing work. Lower J per T is better. Because block discovery is random, solo mining with little hash rate creates extreme income variance. Pools reduce it by measuring miners' work through lower difficulty proofs called shares, then paying under the pool's chosen method. Different systems allocate risk differently, but their purpose is smoother income. Pools do not create additional Bitcoin. They distribute the rewards earned from the blocks their participants help find. Miner revenue comes from the block subsidy and transaction fees. But miners rarely judge a machine by Bitcoin's price alone. They watch hash price. Hash price asks a more useful question. How much gross revenue can 1 unit of hash rate expect under current conditions? It reflects Bitcoin's price, subsidy, fees, and network difficulty. Bitcoin can rise while mining margins shrink if competition rises faster.
Now we can see why the phrase "mining is unprofitable" is too broad. Take 2 real machines and place them under the same market and electricity assumptions. Bitmain rates the Antminer S19J Pro 104T at 104 terahashes per second and 3068 watts, 29.5 joules per terahash. The newer S21 Pro is rated at 234 terahashes per second and 3,510 watts, 15 joules per terahash. In a dated BTCWindow illustration using identical revenue and power price assumptions, the older S19J Pro fell slightly below its electricity-only break-even point,
before cooling, pool fees, repairs, labor, downtime, hosting, financing, taxes, or depreciation. Under exactly the same assumptions, the S21 Pro retained a clearly positive power-only margin because it produced more than twice the hash rate while drawing only modestly more power. Same Bitcoin network, same electricity price, opposite result. The precise dollar result moves with Bitcoin, fees, difficulty, and local electricity rates. It is the relationship that matters. Better energy efficiency gives the newer machine more room to survive. And if power becomes cheap enough, even the older machine can move back above its electricity-only break-even point. Mining is not one business with one break-even price. It is a global cost curve.
There is another reason mining headlines can be confusing. Profit can refer to at least 4 different layers. First, does revenue cover the electricity used by the machine? Second, does it cover direct cash operating costs, such as power, labor, repairs, insurance, hosting, and pool fees? Third, does the operation remain profitable after depreciation and other accounting expenses? And fourth, over the full investment cycle, does it recover the machines, infrastructure, financing, and replacement capital? Those questions can produce different answers at the same time. Riot Platforms provides a useful example in its first quarter 2026 filing. Riot's filing placed its production value at roughly $76,000 per Bitcoin. Its reported direct cost to mine, net of power curtailment credits and excluding miner depreciation, was roughly $45,000 per Bitcoin. After adding miner depreciation, the reported figure rose to roughly $96,000. Below Riot's production value before depreciation, above it after depreciation. This does not prove that Riot as a whole was cash flow positive. Company-wide results include overhead, financing, and other items. What it does show is more precise. Riot's recognized mining revenue exceeded its reported direct mining cost before miner depreciation, while the depreciation-inclusive mining cost exceeded that revenue measure. Depreciation is non-cash in the current period, but not economically meaningless. Hardware can lose value quickly as more efficient machines arrive. Replacement capital is real. So operating a machine today, even if the original investment produces a disappointing full-cycle return, keeping a machine running and buying it in the first place are not the same decision.
Electricity is usually the largest cash expense in mining. Cambridge's 2025 industry survey found that it represented more than 80% of cash-based operating expenses among the firms surveyed. But not every miner buys electricity in the same way. Some have long-term contracts. Some own generation. Some use underutilized energy. Some mine during lower value hours and stop when electricity becomes more valuable elsewhere. Riot reported about $21 million in power curtailment credits during the first quarter of 2026. The company said these credits came from temporarily pausing operations under ERCOT demand response programs. Part of Riot's mining economics, therefore, came from its ability to stop mining. That option is not available everywhere. It depends on location, contracts, transmission, and grid market rules. But where it exists, it changes the question from how much does electricity cost to what is the most valuable use of this electricity right now? For a flexible operator, the answer can change hour by hour.
What happens when mining revenue falls too far? The least competitive machines tend to be curtailed first. Operators may relocate, sell, or shut down equipment. Stronger miners may acquire distressed assets. Bitcoin's difficulty does not react instantly. It adjusts every 2016 blocks, targeting approximately 2 weeks and an average block interval near 10 minutes. If enough hash rate leaves, blocks may arrive more slowly until the next adjustment. If the following adjustment lowers difficulty, the remaining hash rate can expect more Bitcoin-denominated revenue per unit of work than before, all else equal. But difficulty is not a rescue guarantee. Bitcoin's price can fall again. Fees can remain low. Power contracts can worsen. Debt can overwhelm operating margins. and a newer generation of ASICs can push yesterday's efficient fleet toward obsolescence. The protocol does not promise miners a profit. It continuously tests their cost structure.
The miners most likely to survive are not simply the biggest. They combine efficient machines, low all-in energy costs, high uptime, disciplined financing, and the ability to replace hardware without destroying investor value. Some also hold Bitcoin or pursue energy and data center strategies. These can add upside and risk. A Bitcoin treasury increases price exposure, and a mining site does not automatically become an AI data center. Networking, cooling, redundancy, and service requirements can differ greatly. A positive electricity margin is only the first hurdle. If an operator ignores depreciation, dilution, interest, and replacement capital, the machines can appear healthy while the investment destroys value. That is why two apparently contradictory statements can both be true. Bitcoin mining can be profitable at the machine level and disappointing at the company or investor level.
So why do people still mine Bitcoin if it is unprofitable? Because the premise puts every miner into the same box. Some miners remain profitable. Some earn a positive direct operating margin, but fail to earn an adequate full-cycle return. Some have cheaper energy or more efficient machines. Some can earn credits by curtailing. And some are making a calculated bet that Bitcoin's price, transaction fees, network difficulty, or their own cost structure will improve. Others are simply wrong and will not survive. Bitcoin mining does not need every miner to win. It continuously tests which operators can turn energy, machines, and disciplined capital allocation into a sustainable cost advantage. The machines that stay on are not proof that mining is easy. They are proof that the competition never stops. Built for generational wealth.